and tax deductions for the business owner. And when it's combined with a 401k plan, it really maximizes contribution and deduction options for the business owner. Next slide, please. Some advantages of cash balance plans. Typically, a cash balance plan is going to supplement a business owner's existing plan, like a profit sharing plan or 401k plan. And so the cash balance plan is going to allow greater deferral and contribution opportunities than would be allowed under just the defined contribution plan. Defined contribution plan, the annual additions limit is 70,000 this year. With a cash balance plan, it can go much higher, in fact, approaching potentially $400,000. So we'll see some examples of that later on. Also, because this is a qualified plan under ERISA, contributions are protected from creditors at the federal level. So we've got great creditor protection. And according to the Bureau of Labor Statistics, about 99% of cash balance plans offer lump sum payouts. And that can be advantageous for rolling over to a traditional IRA or perhaps converting assets to a Roth IRA. Next slide, please. So understanding where cash balance plans fit, we have to start with answering a number of questions. First off, what plans are currently in place? Does the business owner have, let's say, a SEP or a simple or maybe a 401k plan? If so, what are the contribution levels? Are they maximizing contributions, or does the business owner really want to be able to contribute more to the plan? And then finally, a key area to question is the demographics of the employees. Is the workforce younger or are they older? What is their compensation levels? Highly compensated, mid-range, low, on the compensation scale? Because all of those factors will come into play as we try to decide what plan is the best fit for the business owner, including whether a cash balance plan is a good fit. Now, it's important to ask these questions, but then also to take advantage of doing an illustration. And Paul is going to get into that a little more detail later on in our presentations. But October 3, as a specialist in the cash balance arena, offers these plan illustrations that can be very helpful in determining when a cash balance plan is a great fit. Next slide, please. So, aligning the plan with the business goals. Keep in mind that at the federal level, plans are completely optional at this point. There's no requirement to have a plan. So, in order to entice a business owner to have a plan, there must be some business rule or business goal that they want to achieve, that the plan will help them achieve that goal in the end. And so let's talk about aligning plans with the business goals. Next slide, please. So as I mentioned previously, there's lots of plan options available out there. We have a simplified employee pension plan or a simple IRA. Those are IRA-based plans. We have a 401k. We've got profit sharing plans. We've got ESOP plans. We've got traditional defined benefit plans. What's the right plan? What are the right questions to ask? It can be overwhelming, but really it comes down to what are the goals of the business owner. Next slide, please. Now, I'm not going to read through this slide line by line because you'll need a magnifying glass, and the purpose of this slide is really just for informational purposes only. It's a tool that advisors can use with business owners to help zero in on the type of plan that might be appropriate for a particular business. And it's based on the level of contribution and whether or not the business owner wants employees to participate in the plan as well. For example, with a SEP plan, there are only employer contributions. A simple plan has employee deferrals and employer contributions. So this chart, again, is just for your use to help zero in on potentially the type of plan that will fit the business. Next slide, please. So let's level set here for a moment. There are many factors that will impact the plan selection for a business owners. Where do we start? Probably the important place to start is what is important to the business owner. And in most cases, what's important to the business owner is keeping more of what they earn. And to that end, what kind of plan can help them keep more of what they earn? Next slide, please. So if we reference that slide that has the different contribution levels, and let's role play a bit here. Let's say our advisor, Linda, is working with a business owner, L. And she asked the question, well, L, ideally, how much would you like to contribute toward your retirement each year? And the answer that Linda, the business owner, gives her will give L a clue, give Linda, the advisor, a clue as to what plan would be the best fit. Next slide, please. So let's say L responds to that question by saying, well, I can only put in about $5,000 a year. Right away, that's going to tell the advisor to think about an IRA arrangement. With that lower contribution level, an IRA arrangement might be all that is needed. Next slide, please. But if L's response is, I'd like to contribute about $15,000 a year, then Linda, the advisor, should consider maybe a simple IRA or a SEP plan. But of course, we should ask additional questions again, such as, do you want employees to participate by having salary deferrals, or do you want it to be all employer contributions, etc.? Next slide, please. Now let's say that L's response to the question of how much she wants to contribute on an annual basis is around $40,000 a year. Now, Linda, the advisor, should be thinking SEP or 401k plan potentially, because we know those types of plans can give up to $70,000 for contributions in a year. But again, always ask additional questions to help zero in on what is most appropriate. Next slide, please. Now let's say that L says that she'd like to contribute $60,000 to $70,000 a year. That again is an indication that she should have a 401k plan, because that is going to be the maximum contribution, annual contribution that could be allowed. Next slide, please. Now let's say that L doesn't have a retirement plan in place, and she said, I'm kind of behind on saving for retirement, but I'd like to, if I could, set aside $200,000 a year to catch up. Immediately, Linda, the advisor, should consider a cash balance plan, because cash balance plans can accommodate such a large annual contribution. Additionally, maybe combining it with a 401k plan to give the optimum maximum contribution available. Next slide, please. Finally, let's say that L says, well, yeah, I've got a 401k plan in place and I'm already maxing that out, but I'd still like to put in potentially up to another $200,000 annually. Here, clearly a cash balance plan alongside a 401k plan should be the plan to discuss first. Next slide, please. I'll skip forward to the next slide. These are 2024 maximum contribution amounts, and this is there because plans can still be set up for 2024 up until the business's tax return due date plus extensions. But let's focus now on the 2025 maximum amounts. And in this slide, we can see that if we have just deferrals, or if we have deferrals and add a profit sharing plan, then if we have a cash balance plan in place, what is the total maximum annual contribution that could be achieved? If we look at the younger participant, 35 years old, deferrals are maxed at 23,500 for the year. Profit sharing contributions, that includes all contributions made to the plan, could be up to 70,000. If there is a cash balance plan, it's 93,000. And in total, between the two plans in combination, there could be up to $186,500 as a contribution. If we look ahead to age 55, we'll see that again, we've got deferrals, but we've got catch-up deferrals going in at the rate of 31,000. We've got profit sharing contributions that could go up to 77,500. Here we really see the cash balance plan shining because the participant or the employer being older can receive a $250,000 contribution with all of the combined contributions totaling 361,500. So you can see the older a person is, the more advantageous the contribution amounts can be. Ricky's going to get into more detail on that, but for now, let's skip ahead to the next slide. And we will talk about how cash balance plans work. And that's where I'll hand it over to Ricky.
Thanks, Jenny. Just had to unmute there. Yeah, thanks. So now that we've, kind of shown what a cash balance plan can do and, a little bit about who's a good fit and kind of what makes sense, let's talk about a little bit how about they work. There's, as a cash balance plan actuary, there's a number of like misunderstandings and kind of misconceptions about cash balance plans out there. So we'll talk a little bit about this. Next slide, please. So just to start, it may seem obvious, but cash balance plans are defined benefit plans. And I know that sounds a little bit, scary. Defined benefit plans are dying, whatnot. So what does that mean, right? Well, they're considered hybrid defined benefit plans. They act more like a 401k or a, DC plan than a traditional defined benefit plan that you may be thinking of. There are annual required contributions, every year. Older participants, as you saw in the previous slide from Jenny, they generally can receive larger amounts due to the fact that they just have less time to accumulate balances and assets before retirement. It's generally, completely employer funded. Not really common to see any sort of employee contributions in a cash balance plan. And then lastly, I think this is probably the biggest difference, especially between a cash balance plan and a 401k plan. Almost exclusively, the plan assets are invested in a single pool. That means there is no self-direction of funds similar to a 401k plan. There's no participant election on how they want their money invested. The advisor, you guys would manage the account, and oftentimes there's actually a reason to sort of limit the investment return. You can kind of, the investment return that is factored in kind of counts towards these lifetime maximums that participants have. So, depending on the plan design and the goals of the business owner, it might make sense not to kind of be aggressive in the investment options. And typically it's the same investment advisor as you guys, they're managing the business owner's money, but still just a different dynamic than a 401k. I will mention one thing here that we're seeing kind of grow a bit in the marketplace for a little bit larger plans is they are offering multiple investment pools. It's very new. I don't want to get too into the weeds into it here, but that is an option if it's something that a client of yours or a business owner really is interested in and does not like the single pool aspect. There are some kind of new ways to have multiple pools that participants can elect from. Next slide, please. So what does cash balance mean, right? I'm going to be honest. I don't love the name. I think they could have come up with something better, but this was 20 years ago or more, 30 years ago. But it is a hybrid defined benefit plan, and it's a type of benefit formula that a defined benefit plan can have. It's just not the best name. So we'll take a look at a couple traditional defined benefit plan formulas here, and then we'll compare them to the cash balance formula. Next slide. So a traditional benefit formula typically falls into one of two major buckets. A lot of like more union designs, some blue collar plans will have dollars times service, where you get kind of $50 a month times the number of years of service that you've worked. We don't see too much of that in this space. So most of what we see is pay related. This example here is an example of a final average pay formula. And here Joe is a participant in ABC Inc.'s defined benefit plan. And when he retires, that plan is going to pay him 45% of the average of his last 5 years of earnings. That's just a pretty, standard formula. We'll take a look at another one here. Next slide. And here's Chloe. Chloe's a participant in the LMO defined benefit plan, and that plan calls for an amount equal to 2% of compensation times her years of service. So if Chloe retires with 30 years of service, her benefit at the time of retirement would be 60% of compensation, however that's defined in the plan, and then she would get that amount as an annuity paid to her for the remainder of her lifetime. Next slide, please. We've got our first quiz. So remember, please answer these questions. Answer all four quiz questions if you're here for CE credit. This one, which statement regarding cash balance plan benefit formulas is true? A, no benefit formula is required. B, a cash balance plan's formula is similar to a DC plan approach. C, cash balance plans use a final average pay formula. Or D, cash balance plans must use a service-based formula. We'll give you all a moment to answer, and then we'll talk about the answer. All right.
Sorry that we don't have any Jeopardy theme music to
Music, I
play
know.
during this interlude, but we want to make sure we have time to answer the question.
And all right, let's see how we did. And the correct answer is B. I mentioned this briefly. That a lot of cash balance plans, operate similarly and have a similar formula to a DC plan, and the approach in those plans. Next slide, please. So now we'll show how the cash balance formula does resemble a DC plan. We'll go through an example that will kind of carry through. Acme Law Firm sponsors a cash balance plan, and the benefit formula provides an imputed employer contribution of 5% of pay and an interest crediting rate equal to the rate of return on the plan's assets, on the trust assets. So participants will get a hypothetical contribution of 5% of annual compensation for the year, plus a hypothetical earnings credit each year, right? So annual credit, annual earnings. Looks pretty similar to a 401k profit sharing arrangement, right? Next slide, please. So we'll get into a little bit more detail on this example here. So let's say that Elizabeth here, she's an attorney at Acme and she earns $150,000 a year. So her benefit the first year, she gets 5% of her annual compensation, which is in this case $7,500. That is usually paid. The credit is usually credited at the end of the plan year. So at the end of the first year, she would receive a $7,500 benefit credit. Since that happens at the end of the year, there's no interest credit on that yet. We'll see how that works in the coming slides. Next slide, please. So here you go. You'll see that in year one, the end of the year, she gets that $7,500 employer contribution. Just in the interest of simplicity, we'll assume her compensation remains the same year over year. So in year two, her beginning balance is the same balance as the ending balance from the prior year, or that's $7,500. Then at the end of year two, she receives another $7,500 contribution from her employer. And then during year two, the plan earned 4%. Trust assets earned 4%. So she earned 4% on that original $7,500 credit, that's $15,300. You can move into year three. Again, no comp increase to keep it simple. So her beginning balance then is that $15,300 at the beginning of year three. At the end of year three, she gets another $7,500 employer contribution or benefit credit. And then during that third year, the trust assets earned 3.5%. So she earned $536 in interest credits. So her balance at the end of year three was $23,300. So as you can see, pretty similar to how a DC account works, right? Make a contribution in year one, it earns interest, make a contribution year two. Obviously, DC plans are a little, can be, biweekly or monthly or whatever, depending on the paycheck frequency, but similar in concept. Next slide, please. Now we can get a little bit fancier with the formulas than what we just showed you there with Elizabeth. You can have there's a couple different alternative benefit formulas you can have. This is just one example. For in this example, it's an age-based contribution formula. So a 30-year-old gets 4%, a 60-year-old ends up getting 7%. Um, there are IRS limitations on what you can do here. There are rules that you have to follow in designing the plan, but that's something that the actuary has to worry about, and the actuary will know when it comes to designing the plan. So it just takes a little discussion with the plan sponsor. So yes, like I said, you can get a little bit fancier. It doesn't have to be a flat rate, but there are rules that need to be followed, and that's something that you can consult with an actuary with. Next slide, please. So one of the interesting misconceptions that I have seen, and I'm sure Paul and Jenny would agree, about cash balance plans, it has to do with really with interest rates. So traditionally, cash balance plans used what we called like a fixed crediting rate. So plans would earn that interest credit I just talked about a couple slides ago. Instead of it tracking to the market, they would, credit either 3% or 4% or maybe the 30-year treasury rate. There were proxies that could be used for that too, which means, every year the participant was credited with that percent. So 3%, 4%, 30-year treasury, whatever the plan specified. That meant that the investment advisor, had to kind of manage that portfolio ideally so they hit that number as close as possible, right? Because if your target is 4% and the investments are in 12, you have a problem then. If you overshoot your target, that can kind of limit the contributions and deductions that are available to the business owner. Similarly, if you undershoot it, so say it's 4% and you go a little aggressive and it's a down year and let's say just the plan's flat, now your contributions increase, right? You got to contribute more money because you got to make up for that interest that you didn't earn in the trust. So what happens here is really that your contribution planning just kind of can go out the window with a couple of wonky years, right? Like we saw in kind of 22, 23, 24. You can just kind of see some major fluctuations, and we've got an example coming up that'll show that. Um, you see here Acme, you have market rate of return. If the plan's investments earn 4.5%, you credit participants with 4.5%. So their accounts kind of mimic the trust assets, thus kind of stabilizing the contribution and making it more predictable. So we've seen a lot of cash balance plan sponsors move to market from a fixed interest crediting rate, just because it does add to the kind of the predictability from a tax perspective. Next slide, please. The next slide will kind of really get into an example. But the market, like I said, the market rate of return, interest crediting rate just really helps kind of stabilize and even out a plan sponsor's annual contributions. It minimizes swings due to market fluctuations and market activity, especially relative to fixed interest crediting rates. And as a consulting actuary, contribution surprises or big swings kind of are one of the worst bits of news you have to deliver to a plan sponsor. So trying to avoid those outcomes is ideal. Next slide, please. And here's the slide I was talking about. So we're going to kind of look at a fixed rate plan compared to a market rate of return plan over about a 7-year period, which is a fairly typical time frame of some cash balance plans, 7 to 10 years or so. So you've got a plan sponsor here who, you're working with them and they tell you, hey, I'd like to contribute $100,000 per year. That's the plan. That's what I'm comfortable with. That's what I'm budgeting for, right? So you look at the two designs. So that second column and the second to last column on the right show the contribution levels under a fixed rate design, assuming a 4% interest crediting rate. And then we show the actual rates of return for those years there kind of in the third column. So you can see, first year you're good. It's $100,000, whether it's market rate of return or fixed rate, right? But in year two there, that's where it just immediately starts getting out of whack a little bit. Um, you're crediting participants with 4% interest, but the trust earns 12. So what happens now? Like I said earlier, you've got a little bit less to contribute. So now the owner, only has a $90,000, $92,000 contribution and deduction, when they were kind of maybe hoping for, you know, planning for 100,000. I'll kind of skip through a couple years here, in the interest of time. But look at year seven, right? So you've watched all that fluctuation, and now you've just kind of seen how just things can work over 7 years. And in year seven, not a great year for the market, right? But with all the other accumulations and whatnot that's happened over the last 6 years, look at that contribution for the plan sponsor there, right? So they're hoping to contribute, 200 or $100,000. And you're telling them in year seven now that they owe $225,000. That's not, like I said, it's not a very fun conversation to have as a consultant, as an advisor, as anybody. And you'll see, the 3 years before that, they lost out on, they were planning to contribute $300,000 in years 4 through 6. And what? They ended up getting to contribute, $240,000. So they lost out on 60K of deductions there, and then they've got to make it up. Again, looking at that far right column, because participants earn the actual rate of return, for the most part, there is a floor. Uh, the contributions are very predictable, and the client is much happier knowing that, hey, I contributed $100,000 per year. That was my goal. That's what I wanted. It's just a much better relationship, and it kind of, makes plan sponsors happier, and it makes everyone involved, it makes their lives happier, as well. Uh, so that's why we're pretty big proponents, or I'm personally a pretty big proponent of market cash balance plans. It just kind of works typically better, more in favor of stability and consistency for plan sponsors. Next slide, please. All right, we've got our second quiz. Which statement regarding cash balance plans is not true? A, no employee contributions are permitted. B, younger participants receive larger contributions. C, owners' contributions vary based on their income. Or D, annual contributions are required. So again, which statement regarding cash balance plans is not true? Again, I'll give you 30 minutes, 30 seconds to a minute to answer, and then we'll talk about the answer.
I may interject for just a moment that it's important to answer at least 3 out of the 4 quiz items in order to get CE credit for today's session. So please participate. You don't have to get the answers correct. You just have to show that you participated.
All right. And the correct answer of what is not true is that younger participants receive larger contributions. Typically, actually, always older participants are allowed to receive larger contributions, again, just due to the nature of them being much closer to retirement. Next slide, please. All right, we'll get a little bit more into some features of cash balance plans here. Next slide. And let's start with the assets. I mentioned, when I started talking this morning, cash balance plan assets are managed differently than 401k assets, right? For a 401k plan, every pay period, or, sometimes annually, or whatever the plan's, provisions are, the deferrals and maybe the match kind of go to the record keeper, right? They're allocated, and then sometimes they're even misallocated. That's happened. And, somebody's dollars going to the wrong account, or they don't make it in, and the plan sponsor has to fix that, right? They've got to go through the correction process, or they just fix it themselves if they catch it quickly. But it can be a pain. So the good news for us here today is that cash balance plans are not 401ks. Their assets are almost exclusively pooled in a single trust, and they're managed by an investment professional, an advisor with no self-direction. So you're not really, you make a contribution, it goes into one one big trust, one pool. You're not, divvying up small amounts through hundreds or thousands of lives. Um, and like I said earlier, um, recently, there's an option to kind of have separate investment pool options, but it is a relatively new development. So if it's something that a plan sponsor is interested in, again, I would just consult with an actuary and the trustee to make sure that they can handle it. And if that is something that the plan sponsor is interested in. Um, it's kind of adding to the dynamic nature of cash balance plans. They were a little less dynamic, than 401ks. You know, historically. We'll see where this moves moving forward, but I just want to let everyone know that it is an option that we're kind of seeing, very infrequently, but we are seeing it out in the space. Next slide, please. And we're going to go into another quiz. Hopefully, everybody's awake and paying attention, so they don't miss one of these two, because like Jenny said, you have to answer three. For this one, which statement best describes the investment strategy for a cash balance plan? A, younger participants, uh, or sorry, a conservative rate of return is targeted. B, younger participants receive a higher rate of return, or each participant determines their appropriate investment strategy, or fixed annuities are the only permitted investment option. All right. Uh,
And yeah, well,
I
I
think
know why you're surprised, Ricky. I
I
think,
think we switched the order up on these. The
yeah,
correct
yeah.
answer is B. Sorry, Jenny. Uh, Conservative rate of return is targeted. I mentioned that earlier. Larger rates of return on a market return cash balance, it's not as big of a deal, but on a fixed rate cash balance plan, significant positive returns can have an impact on future contributions and future deductions for business owners and plan sponsors. So typically, you kind of target a more conservative, more moderate rate of return in a cash balance plan. One other reason for that, not to get into too much nuance, is the earnings, the interest credit, the earnings that participants do earn on these benefits do count towards lifetime limits, lifetime maximums. So, for regular rank and file staff folks, that's not really an issue. But, for owners and whatnot who may bump up against this limit, you kind of want to minimize that. Some owners may want to minimize that interest credit just so they can maximize the actual deductions they get from contributing to the plan. Next slide, please. Now we'll get into a little bit about the cash balance plan contributions and some compliance for cash balance plans. As we kind of mentioned and talked about here, older participants can typically receive larger benefits, again, as long as they're not at their lifetime maximum. And why is that? I've said this a couple times, but they do have fewer years to accumulate contributions prior to retirement, and it's nice of the government to allow them to kind of catch up, especially for business owners who maybe invested a lot of money back in the business earlier in their careers or earlier in the time frame of the business, and now they've reached their 50s, and they're like, I'm trying to catch up. I've invested so much back, now I can make that money up. So it is nice that there's higher limits for older participants. um, you know, an actuary is retained to determine these contribution amounts. There's nothing that the plan sponsor needs to do, nothing the advisor or the CPA needs to do. Um, they are like 401ks in that you have to file 5500s, and there are some required annual notices that need to go out to participants, similar to 401k plans. But again, most of these requirements are on the actuary. They'll put everything together and help these get delivered. One other thing is that the 5500 requirements are usually less complex, especially for smaller plans, and the notice requirements are less complex as well. So while they're similar, they're not 401ks, right? 401ks and cash balance plans kind of operate in the same space, but definitely have their differences. There's just not the same level of work associated with administering a cash balance plan as there is a 401k plan. Next slide, please. Um, Cash balance plans do have IRS compliance testing requirements that they must satisfy. Um, Oftentimes, to kind of get the most bang for your buck, you combine the cash balance plan with the 401k plan for testing. This kind of allows you to maximize the benefits for owners and high income individuals. Again, though, all these tests, there's nothing that advisors get involved with. The actuary, we perform the testing. But typically during the design phase too, we kind of typically try our best to set the plan up so that so it will satisfy testing year after year. So we don't like surprises. Don't want to have surprises for plan sponsors or business owners. So, that's kind of our MO, is kind of set these up so there aren't surprises at year end. And 401k land is kind of a little trickier to set up that way. You kind of just kind of end up with surprises because there's only so much you can do. Next slide, please. So as I said just briefly a minute ago, it's usually best to combine the 401k and cash balance plans from a testing perspective. I don't want to get into the nuance of how this is done. That would put people to sleep. But effectively what we do is, we convert the 401k balances to hypothetical annuities at retirement to compare them and kind of pretend they're the same type of plan. You can go the other way too, where you can both pretend they're, 401k types and, on that methodology. But either way, this doesn't affect the advisors, doesn't affect the plan sponsor. There's no work on their end. It's under the hood compliance testing that the actuary takes care of and worries about. But just wanted to note that it is out there and something that needs to be done. Next slide, please. There are a few, more unique tests to cash balance plans. One is called the meaningful benefits test or the 40/50 test. This test just ensures that at least 40% of eligible employees, or 50 people if less, are receiving a meaningful benefit. So if you have a plan with, 60 partners, or a firm with 60 partners, as long as 50 of them are participating, it doesn't really matter if the staff is participating at a meaningful level. It does not matter if the staff is participating at all. You just need 40% of the total, eligible population, or 50 people, if that is smaller. So, again, what is a meaningful benefit, right? Well, a meaningful benefit is at least 0.5% of compensation expressed as an annuity at normal retirement age. You don't need to know what that is. You just need to know that is pretty small. It's pretty easy to hit that threshold. It really is almost never an issue for clients to provide a meaningful benefit based on the IRS definition of that. And again, not something for the advisor or the plan sponsor to worry about. It is for the actuary to worry about, but it's part of the overall adoption of the plan, and overall planning, when it comes to designing the plan and how it's used for benefits. So it is important to kind of note. Next slide, please. So this is kind of maybe one of the biggest questions we get all the time. I'll get a prospect or a plan sponsor just saying, I've got a business owner, and he's 60. He probably wants to stay in the saddle for 6, 7 years. How long do these plans have to run? How long do we need to run this plan? Well, the IRS has what they call a permanency rule. And what all actuaries and people find funny about this is that the IRS has never ruled on exactly how long a plan has to stay in effect. There's kind of, themes and ideas. You can't just kind of keep starting, terminating. Can't keep. There's general, ways to go about this. So just through the years of seeing what the IRS kind of responds to when plans terminate and whatnot. As a general rule, at least 3 to 5 years, depending on the plan. Smaller plans kind of can get away maybe with a bit shorter time period, a little less scrutiny. The larger the plan, we kind of recommend maybe 7 to 10 years. If, you're talking a couple hundred participants or whatnot. But again, general rule, 3 to 7, 3 to 10, 5 to 10, somewhere in there. It's just, And obviously things happen. I worked on a plan recently, they went into bankruptcy and the plan was only around for 2 years and, we had to terminate it. So there's always, exceptions to every rule, but it's just kind of a good rule of thumb. You want to have the plan in place. You want to plan to have the plan in place for at least 5 years. Next slide, please. One other thing to note here that is unique to defined benefit plans is that some plans, some cash balance plans, and other defined benefit plans are subject to what is called PBGC coverage. So the PBGC, or the Pension Benefit Guaranty Corporation, is a federal agency. It's basically a federal insurance program for pension plans. They step in to kind of make benefit payments if the plan is unable to do so. So if the plan sponsor goes bankrupt, or there's not enough money in the plan, the PBGC will step in and pay plan benefits up to a certain level. This is usually good enough to cover kind of staff benefits, participant benefits. And obviously the certain level that it covers up to is not high enough to kind of cover all of owners' benefits. But, if a company goes bankrupt, the owner probably, they've already put enough money away anyway. So, like I said, it's essentially insurance for pension plans. The cost annually right now is about it's $106 per participant. That does get kind of indexed up every year a bit. And then there's another kind of 5% of unfunded liability. But most cash balance plans stay pretty well funded, around 100%. You kind of get out of that part of the premium. So generally assume $100 per person in insurance premiums for a plan. Next slide, please. A little bit more about PBGC coverage here. If there are less than 26 active participants and the business is considered a professional service, or if the plan is owner only, can be husband and wife or sole proprietor, that kind of thing. Those plans are not subject to PBGC coverage. So they do not have to make that filing. They do not have to pay those premiums, but at the same time, they do not get, the protection from the PBGC in the event that the plan goes under or the company goes bankrupt. But again, sole proprietors, not really a worry there. And then, professional service organizations, that's just another exception to kind of get out of this, because usually they're, higher paid individuals and partnerships and whatnot. So again, I'm going to say this again, this is something for the actuary to worry about, not the advisor or plan sponsor. As with most of this, that's what makes these plans kind of easier for the plan sponsors, that the actuary does the bulk of the heavy lifting for them and for the plan. Next slide, please. Interestingly, plans that are covered by the PBGC do or can potentially have larger contribution limits. So if a client does have a 401k and a cash balance plan and they're subject to PBGC premiums, potentially that employer can contribute and deduct more than if they were not covered by the PBGC. But again, something for the actuary and the person designing the plan to worry about, not so much for the plan sponsor. Next slide, please. All right, this one's fun. This is a good way to sell a cash balance plan, right? So let's talk about distributions. So they're relatively similar to what we see in 401k world, right? You need to have a triggering event, which is typically separation from service or reaching full retirement age. But new rules now have dropped the age that makes people eligible for an in-service distribution to 59 and a half. And what that does is that allows individuals who are nearing retirement to take distributions and roll them over and invest their funds how they see fit. So remember, I said that cash balance plans typically are invested a little bit more conservatively or moderately. So this allows older folks to kind of put a bunch of money in, get the deduction for that contribution, and then immediately they can roll it out into an IRA and invest it, maybe not immediately, but within a few months, whatever, they can roll it over into their own personal IRA and invest it how they see fit. They can invest as aggressively as they want. They can put it in crypto. They can put it in, they can put it in ESG funds. They can do whatever they want. It allows, it's what we call them round trippers in our world. They kind of put their contribution in at the end of the year. They take it out early the next year and then invest as they see fit. So they never kind of have that money sitting in a more conservative investment pool for very long. So that's kind of a nice perk for folks nearing retirement. And then again, if you do kind of roll it over into a Roth or take it as cash, any payment made directly that in that way, they're subject to 20% federal withholding. Next slide. Another quiz. What plans are not required to pay PBGC premiums? Owner only, defined benefit plans maintained by small professional or service organizations, safe harbor 401k plans, or all of the above. We'll give you a couple 30 seconds here, and then we'll keep moving. All right. The answer is D, all of the above. None of those types of plans are required to pay PBGC premiums. Next slide, please. Next slide. So where do these fit? Jenny touched on this quite a bit at the beginning, so I'll kind of keep this short. Um, Significant levels of income. They kind of want to have consistent, significant levels of income. That helps. I've worked with real estate agents who can kind of yo-yo a bit, and that can be a bit tricky. As just one example of someone that may not have consistently high income, but yet may still want or be interested in a cash balance plan. They've got to have an appetite for tax deferral and deductions. And they've got to have an appetite, they want to be able to keep this plan open for 5 or more years. Um, and likely, they're willing to make some contributions to non-highly compensated employees and their staff. If they answer yes to these questions, let's talk cash balance with them. I think they're a candidate. Next slide, please. I saw this kind of coming in the Q&A earlier. What are some good targets or industries, to kind of go after? I will say that my clients range, the larger ones are typically medical groups, law firms. I've worked on architectural firms, accounting firms, like I just said, a real estate agent. I've had kind of like sole proprietor IT folks. Again, just anybody, with consistently high income who is kind of looking to put money away for retirement. Typically, we look at people, 40 and older, 50 and older. But I've seen people in their 30s want to do this as well. If they own a business. So yeah, it's not limited, but those are kind of the top candidates. Next slide, please. I'm going to turn over to Jenny, back to Jenny here. Sorry for
All
going so
right.
long, Jenny.
Thanks, Ricky. We're going to move into the logistics of establishing a cash balance plan. But let's just reiterate the fact that cash balance plans can be a great tool for the right employer, but they aren't right for everyone. There are certain circumstances where a cash balance plan would not be appropriate. For example, poor tax efficiency, and that means where the plan would have to provide high contributions to non-highly compensated employees in order to allow the highly compensated employees to get their maximized contributions. Costs. Small businesses in particular might not be able to afford the costs. I mean, you've got the cost of the contribution, the cost of record keeping, the cost of the actuary, et cetera. So cost might be an issue. If a business has inconsistent earnings, because it's a cash balance plan, a DB plan that requires a benefit be provided, it requires contributions, we need to have consistent earnings. And of course, the demographics of the labor force. Again, why it's so very important to have an illustration done based on your employee demographics. Next slide, please. Here's a really important slide. We want to focus on the cash balance team. And it takes a village. So the saying goes, well, in a sense, it takes a team to make sure you have a successful cash balance plan. At the center of the team, of course, is the business owner. They're going to determine the team and make the final decisions. Assisting business owner is the financial advisor. They're going to work with the employer or the business owner to identify what their retirement goals are and come up with investment strategies to be able to make sure that the cash balance plans achieve those goals. Now, advisors sometimes have the misunderstanding that they have to, actually do the formula, et cetera. And that's just not the case. That's where we have the actuary, another very key member of the cash balance team. The actuary does the heavy lifting on the funding of the plan, performing the tests for the plans, perhaps has drafted the plan document or has a plan document available, a pre-approved plan available, and Form 5500 reporting. So actuary, another very key component in the team. CPA associated with this business owner, that individual or entity is going to be very helpful to the business owner in determining their tax goals and what income can be used for plan purposes, et cetera. And then finally, if we are combining a 401k plan with a cash balance plan, there needs to be a 401k TPA or third party administrator. They're going to handle the 401k portion of the plan combo, doing the testing, doing the filing, etc. So that's our team. Important to know who the members are and the roles and responsibilities. And financial advisors shouldn't, feel that they have to do it all. It's really turning to a good actuary and a good, if we have a 401k plan, TPA. Next slide, please. Finding the right TPA can be tricky. Financial advisors often have a list that they have worked with and can recommend a TPA. Otherwise, employers, business owners can consult with a defined contribution investment only or DCIO wholesaler. There are trade associations that can help you find the right TPA. And then also, once you maybe have a couple of candidates, find out if that TPA also does cash balance services. If so, the number of cash balance plans they've done, are they solely focused on cash balance or do they have other arrangements? And then what is their actuarial services or what are the actuarial services that they offer? Next slide, please. Finding the right actuary is key. Again, turn to the advisor who can recommend, the TPA or advisor or TPA can recommend the right actuary in many cases, trade associations. If you've got a couple of candidates, actuarial candidates, important to vet those candidates. How many cash balance plans do they run? Are they focused solely on cash balance plans? And then really important is what is the succession plan or backup strategy? If this actuary say is going to retire or if something happens, who's going to take over the plan? Next slide, please. As I alluded to earlier, very important to do a plan feasibility study or what we refer to as a plan illustration. The TPA or the actuary can provide this. O3 does plan illustrations. It's based on employee census data, the business structure, compensation, the owner's objectives, and are there other plans in place? We're really digging deeply into the key elements on whether or not a cash balance plan is a good fit for a particular employer. Next slide, please. So I'll go through these next couple of slides quite quickly so that we have time for Paul to step in here. Now is really a good time to prospect existing cash balance plan. As we talked about earlier, many cash balance plans were set up with fixed rate returns, and now that market rate returns plans are allowed, that might be a better alternative because it gives more consistency and the ability for plan sponsors to plan on contribution amounts. Next slide, please. Plan setup. Here's some quick, straightforward steps. You need a plan document. You need an investment strategy. You need to communicate the plan, make the contributions and ongoing administration and reporting. Next slide, please. And here's where I'll turn it over to Paul. He's got some examples of plan illustrations to share.
Excellent. Thank you, Jenny. So yeah, everyone, we spend a lot of time here talking about cash balance plans, some of the rules and regulations and things to consider. But at least from the side of the business owner and the advisor, what it really boils down to is this here, right? What do the numbers come out to? What does it look like for the business owner in each particular circumstance? So on the next slide, which we're not going to go to yet, I'll show you what information we kind of gather. And I do see some names in the attendee list that are very familiar to me. So good to see everybody on here. But this is a real life example of some of the output that us at O3 at October 3 would give to you once we collect information in order to be able to kind of put this out there for you. And so for that, I'm gonna go over this, excuse me, go over this here for just a second with you. So this is a real life example. These are three owners. They were physicians. You can see owner one, owner two, owner three, 50 years old, 62, and 55. So you'll start with their 401k column. Of course, that's their elective deferral. They're each 50 or older, so they can do $31,000, total of 93 between the three of them. Their profit sharing, going back to what Ricky was talking about with the PBGC, this is a PBGC exempt plan because it's a small professional services plan. So they'll each get about 5% in profit sharing is what we could do to make the plan testing work here. And then when you get to the cash balance column in the blue there, you'll see 140,000, 315, and $210,000. So some pretty large cash balance credits for them. The total for all three of these physician owners was $810,500. So a nice hefty chunk of money that they could do on an annual basis. So, okay, great. So that looks great. But of course, one of the main factors here is if you're a business owner looking at a plan like this for tax purposes, mainly, right, to try to figure out how much of this money can be retained by the business owner, then the question is, what do I have to give to my employees, right? Well, let's skip the HCE rows, which are kind of the middle rows there, the non-owner HCEs, and we'll go down to the non-owner NHCEs or non-highly compensated employees. These are the folks that are most meaningful when it comes to the testing of the plans to make sure that they pass compliance testing. So you'll see in this particular example, the non-highly compensated employees all got 7.5% of pay. So in total, it cost the employer $22,500. And then we included all of them in the cash balance plan at a minimum meaningful benefit, which in this case just worked out to about 2%, right? Could have been a little different than that. We could have had different percentages, but for simplicity, the owner said, yeah, 2% across the board is great. The other thing to notice is, we had said earlier, you only need 40% of the population in the plan, right? So you see that there's 10 people here. You could have had the three owners and one other person, but when push comes to shove, when they say, well, we can either pick one of these NHCEs or just put all of them in there so that there's no, potential HR situations or someone gets jealous that someone has, a cash balance credit and they don't. They said, look, it's only $6,000. So we just put all of the non-highly compensated employees in the plan, cost the employer $6,000. We'll go back up to the HCEs. You'll see they're each receiving 3%. That's because they're highly compensated. They don't have to always receive that minimum of 5 to 7.5% that you see with the non-highly compensated employees. So really, bottom line here is that bottom right number, $854,000. That's what's being put into the plan that will be deductible to the owners. So, federal, state taxes, let's call it 40% in some areas. You can do the math. 40% of $854,000, you're looking at quite a large tax deduction on an annual basis. And then moving back up kind of to the top left there, where it says percent to owners, you'll see that the owners in this particular example are retaining 94% of all the money that's being funneled into these plans. So this is a perfect example, great demographics, and really worked well for these folks. Next slide, please. So in order to create an illustration like this, we just need to gather some census data. This is an example of our format that we require to pull this together. Pretty simple stuff, name of the company, the industry. That again is to determine if they're PBGC covered or not. What tax year do you want to begin the plan, right? We can still begin plans now for the 24 plan year. So we need to know kind of what we're doing there. Where people kind of get caught up are some of the specific things, like when it says taxation type, right? Sole prop, partnership, S corp, C corp. Well, a lot of times folks will try to put LLC in there, but an LLC is not actually a taxation methodology, right? It should be LLC S corp or LLC partnership. And the reason that's so important is if you look at the bottom of this page here, we kind of put out there, hey, look, for sole proprietors, we need certify that compensation is net Schedule C, line 31. Or for S corps, W-2 only without any pass-through income. And I'm talking about compensation for owners only. Of course, employees are always W-2. But many times we might receive something like this back, and the owner has told the advisor, yeah, I make $1 million a year in my S corp. Well, if you make $1 million a year in your S corp, some of that is much of that's probably pass-through income. What are you actually paying yourself W-2? Because government regulations require us to only use W-2 income as the basis of calculating these benefits. So that's something to really be careful that you have the right information there. And then other things like, do they have a SEP or a simple? Generally, a SEP and a simple, you can't have in the same plan year. So if they have already funded a SEP for 2024, for instance, we'll probably have to look at implementing a plan for 25. Same thing with a simple. Do they currently have a 401k? And if they have a 401k, is it a match or is it, what's the setup, right? If it's a match, it's generally very important for us to get the 401k document, but especially if there's a match, because there's additional calculations we have to do. And unfortunately, that match generally doesn't count towards those compliance tests, but we need to make sure that we understand what has been deferred by the employees, what has been matched, so we can make sure that we pass all of our tests. So with that information and a little bit of qualitative information, right? You send this to us and you say, hey, I'd like an illustration, and here's what we're trying to accomplish, right? Maybe there's 4 owners, but we're only trying to target 2 owners because the other 2 are phasing out. Or maybe there's 1 owner and a couple really key employees that they really want to target for a larger benefit. The more we know when we pull together the initial illustration, the better we can be, the better information we can provide to you to help you go try to win and close that deal. Jenny?
Thank you, Paul. And I know one question that came through is, how much does that plan illustration cost?
Plan illustrations are, we do those complimentary, and we actually try to return them to you within 2 business days, sometimes sooner, especially if it's a much smaller plan. We many times turn that around in 1 business day. That is, of course, with complete information. And we always try to ask a few questions to make sure we're getting you the right type of illustration first, but generally within 2 business days and complimentary.
Great, thank you. Lori, I'll ask you if there's any other questions. I know we're over time right now, but we can stay a few more minutes if there are some questions that you have in the Q&A.
Yes, we actually have quite a few, and I don't know that we will get to them all. So this would be a good time to let everybody know that if we don't get to your question, just know that they've all been logged and that we will be reaching out to you individually after the event today to make sure that you get a response to that question. So even if we don't answer it live here in the webinar, just know that we do have a record of it and we will be reaching out to you about your specific question. And then we had a few come in to ask about the recording and the slides, and yes, those will be provided as well. We just kind of have to wait for this recording to finish processing today. And then I would say within the next 1 to 2 business days, you should see an email from October 3 that will have a copy of these slides, a link to the recording, and probably some other goodness from October 3 for your inbox. So we will, we'll just start here. Who procures the private letter rulings for the client? Is that the TPA's job?
Well, if they're talking about a determination letter, our plan document is an IRS pre-approved rubber stamped plan document, so it's generally unnecessary.
And someone else kind of on that same theme asked, are those private letter rulings common? Are they recommended as a means of protection from audits?
I don't know if Ricky has a statement on that. Generally, if you have an IRS pre-approved document, and as long as we're operating within the confines of that document, and our document has plenty of choices for setting up a plan, then you already have the kind of the blessing of the IRS that the plan is qualified.
Yeah, nothing really to add there, Paul. That's good. You can still be audited, but it's just, you've got support that your document has already been approved by the IRS. They can audit for other reasons and ask other questions. But yeah, it doesn't prevent an audit, but it certainly doesn't hurt in the event of one.
Can the rate, oh, sorry, go ahead.
No, I was just going to say if they are focused on private letter ruling, it may be in the circumstances where a fixed rate plan is moving to a market rate. There's been some conversations about is that permitted or not. Some employers feel more confident to get a PLR, but it's only reliable for that particular employer.
I have a rate of return question. Can the rate of return specified change yearly? For example, during ZIRP, interest rates were hardly anything, so getting 4% was out of the question, absent tremendous risk, versus now 4% is reasonable.
I'll
Are
take
they,
that. I'll take that,
okay,
Ricky.
go ahead. Go.
Yeah.
Yeah. So the bottom line with the market return, and this will probably answer another question I'm seeing on here about a fixed, a question about whether don't you have to use a projected interest rate or kind of standard interest rate. The main difference between the market return and a fixed rate is this. On a fixed rate, you are prescribing in a plan document, let's call it a 4% rate of return. In a market return, we are generally prescribing that the plan has to land somewhere between 0 and 6% over the life of the plan. Now, there is a preservation of assets in there, so it can't really dip below 0%. But you can have a few years with 10% returns, and then a year with a negative 15% return, and then a year with 3% and 5%. And it's not going to make the plan overfunded or underfunded. It's just at the end of the plan, hopefully, if our actuaries have done the projections on, hopefully they will have done their projections and understand where the funding is. Let's say the return has been an average of 11%, and the prospect has been maximizing their contributions based on their age every single year. Then they might be a little bit overfunded. But with good consulting and good connection to your actuary as the advisor or the plan sponsor, you can call and say, hey, we're thinking about terminating this plan in the next year or two. And the actuary might say, great, you're a little bit overfunded for the last year. You might have to put a little bit less money in, and that'll get us to the right funding level. Or for the last 2 years, let's raise your benefit, right? We can, if there was space, right? Because benefits changed with cost of living adjustments as time goes on. So maybe there's some more room to raise the benefit that you accrue every year, but put the same amount that you've been putting in, and that will catch you up. So all the market return really does is make it a heck of a lot easier to manage to that a rate of return within some kind of, again, within a spectrum rather than trying to hit that 4% every single year.
I think we maybe have time for one, maybe two more. Is the PBGC underfunded?
I can take this one. It is no longer. It is currently overfunded. That is the reason why they have stopped indexing the variable rate piece of the premium. I don't anticipate them ever giving the money back. It's worked into their budget. For anybody on this call who does have clients with PBGC premiums, they are due a month earlier this year due to that budget issue. 10 years ago, when the budget for the next decade was